Folks, this is Roger Scott, and I'd like to welcome you with Jeff Zananeri. We're doing our midweek roundtable. I'm the senior strategist of WealthPress, and Jeff is the senior strategist of Joy of the Trade. And please, 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 welcome to the show. Send us email, like us on Facebook. Jeff, how are you doing this morning?
I'm excellent, Roger. Nice to be with you.
You as well. So, what is today? Today is Wednesday. I'm so mixed up by this market.
Yeah, midweek.
Tomorrow we have employment report. Well, we have the jobless claims, and then Friday we have the unemployment number. I wanted to talk to you a little bit about the bond market, and I wanted to get your take on the relationship right now, because there's been a lot of talk about how the bond market is putting a wet blanket, so to speak, on the stock market. And I wanted to get your 5 cents on that. I wanted to get your perspective, and then I'll tell you what I'm thinking.
So I'm watching this 10-year yield like everyone else. I woke up this morning at 5:30, as I always do. I'm a little bit of an early riser here on the East Coast I like to see what Asia's done. I like to see what Europe's doing, do all my research before the family starts stirring, et cetera. But futures were pretty strong. They were bid. Nasdaq was up 1% pre-market at like 5:30 in the morning. Europe was very strong. And I saw something peculiar out of the corner of my eye on the Bloomberg, and it was the 10-year yield was going up from 140 to like 143. I'm like, that's strange. Market super bid, but market didn't like higher yields last week when we had a little bit of our tantrum. And so sure enough, yields broke, 10-year broke above 1.45 this morning. And you saw, boom, they flushed it all down. Nasdaq went from up 1% to down 0.5% on a 3 basis point move in the 10-year. So anybody that tells you that it doesn't matter, well, maybe in the long run, it doesn't matter so much, but in my world, in my timing, it matters. It's everything. And so I'm watching, there's always one chart, there's always one asset class that is the ultimate indicator. And that's what like everyone looks at as the tell to the market. And, in the past, it could be oil, it could be gold, it could be the dollar. But right now, it's a 10-year yield.
And I couldn't agree with you more. Let me run something by you, and I want to get, and I'm really glad that, while you were giving your analysis, you kind of separated it into short term and then long term, and you kind of explained that the fact that you're looking at it minute by minute. And I totally agree. Whenever I'm short term trading stocks, the bond market in real time is always there. It's got to be there, because otherwise you're flying blind. You got to have the bond market. And the truth is, even not right now, when it is that asset that's influencing the most, and I couldn't agree with you more, by the way, on that. It is the one that's influencing stocks the most right now. Even when it's not, after the opening bell, intraday trading action, huge inverse correlation between bonds and stocks. Huge, very, very strong. If you were one of those guys looking at a 10-minute chart after the opening bell, their negative correlation is very it's very, especially with financials, it's definitely there. Yeah. But where one can open down a basis point, one can go open up, but then once they're open, I've seen the relationship tighten. But here's what I wanted to talk to you about, and you tell me what you think about my logic. Okay, we are right now anticipating that at the end of 2021, the yield on the 10-year note is going to be at let's say 2.5%, which is a full basis, full 100, a handle above where we're at right now. Right. Okay. Nothing crazy, right? 2.5%. Okay. That's still very, very low. I mean, we're not in the 4, the 5s, or the 6. 2.5% is still very, very low.
Totally.
So if you look at but here's the point I'm making. If you look at the trailing 12-month expectation right now on the S&P 500, the yield on the S&P 500, earnings yield on the S&P 500 is, the S&P is expected to be up at about 4,200 right now based on earnings. And if you take that, if you do the calculation backwards and you imply the earnings from it, it's right now pricing in 3.5 to 4.5% interest rate yield. Okay. So, and I looked at, so what I did was this, me, I'm a numbers guy. So I looked back all the way from 1980. Okay. And I wanted to track the earnings yield on the 10-year note. And I wanted to compare it to the stock market, to the S&P 500. And guess what I found out? On usually, and again, this is not minute by minute, this is, over time, you will find that the S&P's interest rate level is roughly, give or take, 100 basis point, one handle above the 10-year note. Okay, real simple. And I went back. I went back about 45 years, 40 years. I had a little time on my hands. So, and you'll find that if interest rate, if the 10 years yielding 6%, the stock market at the end of the 12-year trailing period will yield about 7.5%. It's typical this way. Right. So my point is, and sorry, I'm taking so long, but I wanted to go through the whole process. I thought,
it's interesting.
Right. I can't just, you understand this, so in a nutshell, where am I going with all of this? Very, very simple. The stock market is pricing in right now the fact that interest rates are going to go up another point unequivocally in its price right now, based on what we're seeing right now. And this is not a theory. I'm looking at the actual numbers based on the expectations of a trailing 12-month 2021 December. Yeah, I could show you once we get off here, I could show you the full calculation, but we're right now more than a point away from what S&P is pricing into its value right now. Isn't that interesting?
Totally interesting. So what is your final?
My conclusion is this, that the S&P that the bond market can fall a bit more. And that is already priced into the value of where the S&P and all those tech companies are that are subject to a strong amount of deflation. That's the bottom line. So I wanted to see if you agreed with that.
Well,
do you believe that the stock market can stay around these levels with interest rates basically going a bit higher, or do you think it's a death knell?
I'll tell you what the problem is. I'll tell you the one caveat to the whole thing. First, I'll say, historically, you're 100% correct, and the relationship between S&P dividends and the yield on treasuries is constant. It's pretty constant. There's not a lot of wiggle room. It's been a pretty solid thing. I think it goes between like 250 basis points to like 100 basis points or something is the average range, the band.
Right. That's been the premium on the S&P, between a point and about 2.5. Yeah, that's exactly right. For the last 40 something years.
Yeah, exactly.
Yeah.
But this is the thing. This is the problem. But this is my problem. This is the one caveat. Because yield got so low on the treasury, and people are passive investing for the past 5 years, or specifically in the past year. They're just putting money to work. And how are they doing it, Roger? They're doing it 60-40 model portfolio, which means they're buying 60% stocks, they're buying 40% bonds, treasuries mostly. And that's the average like asset allocation that the robo-advisor does for people. I'm not talking people like me and you. I'm talking like what it spits out. So when you
the 401k, right.
If you get that move from 1.5% to 2.5%, which you're going to get, if you get it suddenly and shockingly, you're going to have a lot of people open up their portfolios and see the bond portion of their investment down 25 to 30%. Which is huge if it's 40% of their portfolio. My problem is that people are we're all psychological animals. So if the stock market is just doing what it does, it needs to do a lot more just to make up for that hole, to make it feel okay. We've been in a bull market in stocks and bonds, which is not normal, for about 10 years. So people have been very used to making money on both sides of the asset allocation. We're going to go back to the normal correlation, which you described, which you can go back 100 years even. It's very solid for 40 years, where bonds sell off, but stocks still go up. But I think it's going to maybe, if it happens shockingly, cause a little bit of pressure in the stock market. That's my only caveat because of this. Okay. Because of the correlate.
Because it's so over. Right. Gotcha. So basically, what you're saying is, in the long run, it's not going to be a big deal, but because of the velocity, if you will, of the move, and if it happens in the short term, it could. I agree with you. Yeah. My calculation does not.
It'd be an awesome buying.
This was not a short-term analysis.
It's an awesome buying opportunity for stocks if it happens like that.
If it happens, my point is, I just don't see. We've been hearing a lot of talk over the last week and a half that, hey, the bond market is, it's really, and I'm like, well, and I agree with you. Yes. In the short term, 100% agree with you. But overall speaking, generally speaking, I think the stock market's got some more upside based on the bond market, and even if the bond cools off a little more,
it does have upside.
I do.
It has momentum because because the real thing you have to do is you have to grade life on a curve, and you have to always say to yourself, even if it goes to 2.5%, 2.5% kind of sucks. Nobody wants 2.5%.
Right.
I remember when money markets were
exactly
5%, right? So everything is always going to be. You could buy a preferred stock ETF of all blue chips companies and get north of 5% dividends plus the growth of the business. And it doesn't grow and common stock, but there's a lot of things you can do to make a better yield than 2.5% in this world right now.
Of course, absolutely, and those financial, and remember, those financial companies in the stock market they still haven't bounced. We've been talking about that for a year. Imagine when they start bouncing up. That's going to have a big impact on the fair value as well, I believe. So, but anyways, I kind of wanted to explore this with you and kind of give our readers a little understanding of there's actually a way to use the bonds, because a lot of our readers, they just don't understand that there's a way to use bonds to determine the fair value of the stock market based on the yield on the 10-year versus the yield on the S&P 500. And that's a very, very important tool. And I just want people out there to know that there is a relationship. There's a fundamental relationship that goes many, many years, and we're still within that zone.
It's important. Listen, money goes to where it's best taken care of. Money goes to where it's best taken care of. And as long as that's still the stock market, that's going to be where it goes. That's going to be where it goes.
What do you think? And what is your reaction? Or what do you believe? Better question. What do you believe of the markets, the way the market is reacting to the stimulus news? Do you believe it's overdone, underdone? How give me your thinking on that.
I think everybody knows that there's going to be stimulus. I think there's zero surprise. There's maybe less. Is there a number less than zero that you can price into a surprise value? Because
what I mean from my perspective is more from a perspective of based on how we were talking about the bond market, how last year when Fed took action the first time, it had a crazy reaction. Second time, it had a medium reaction. Yeah. So my question to you is, that's kind of what I'm talking about. Do you think the reactive nature of the stock market do you think it's what you expected? Is it less? More? What do you
something interesting has happened the last few months that I've noticed. The stock market has reacted good to anticipated news. I'll give you an example. Was it yesterday? No, Monday. I'm lost in the week too. Monday, our biggest up day in months, was on the back of very positive Johnson & Johnson vaccine news. Yes, also the bill passed and it's going to the Senate, but people kind of knew that. But this Johnson & Johnson was also a foregone conclusion. We went Friday with everything being all systems go. And then they said it's coming out. And the stock market ripped on what everybody already knew was going to happen. So my summary is this. Once this bill passes, it's going to be very bullish for the stock market. It's going to be another bullish leg for the stock market. We might have volatility until then, but once it's free and clear and it's done and it's ironed out, you'll probably get a pretty good, nice pop.
I agree. It's a lot of money. Not only is it a lot of money, remember, people are getting a direct payment again.
Yeah,
remember what happened.
The money coming is the big thing, right? The money hitting the bank account is the big thing. That starts happening, and people instantly spend it. Instantly.
Well, and that's exactly where I'm going. Where do you think the runs are going to be? What are you seeing this because we're kind of coming back, where people are a little bit thinking a little differently now about going out versus staying home. We're seeing some going out stocks like Trip, Marriott, Rick's Cabernet. A lot of people don't know that Rick's is a public company. They were very, very interested. A few people thought that the pole back here was a dancing pole instead of a light. No joke. But anyway, folks, you can invest in a Nudie Bar, ticker symbol RICK. I thought it was public information, but so what do you make?
I'm of two minds. I think that some stocks are overdone on the reopen. I think the reopen is going to be powerful. I think the winners of the reopen should get bid the way they're getting bid. I think third place it shouldn't, perhaps. Like a bad air, like a crappy airline was a crappy airline before COVID. Should it be trading higher than post COVID? I don't think so. The best airline should, but should a crappy one? Probably not. And that's my philosophy on a lot of things. But I think even more importantly is the sell-off you're seeing in certain companies, where I don't think the genie goes back into the bottle, because people are going to be like using Zoom, for instance. People are going to be using PayPal to pay each other. I think like PayPal had a big whack on the reopen story. And that's a stock that you can like leg into. It's still one of my favorite companies in the world from a fundamental standpoint. So I think you can use the reopen story from a negative perspective against some companies who I know aren't going anywhere to scale into those positions. And I think you just have to be a little bit careful with not just buying that, like every airline's a great airline. Every hotel is a great, like do a little bit of homework, figure out which ones are great and which ones aren't.
Okay, well, let me ask you a follow-up question to that, because this is, I think a lot of people in the audience are kind of listening to what you're saying right now, and they're going, okay, so you're a little more relaxed this time around than several months ago. And we were right. You and I, we could pat ourselves on the back. We were 100% right. Most of those things didn't do anything. They huffed, puffed, and then they started going down, trending again. So, but okay, things are a little different now. We're starting to go up. Get a little specific with me. You don't have to give me stock names. Give me some sectors, maybe throw a few stock names. What are some of the criterias that you would, here's the question. Yeah. What would you look at? What would you look at in a stock now that, let's say it's the same stock that you would say, I'm not, a year ago, you were like, I'm not touching this with a 10-foot pole. What would make you reconsider that stock right now?
Where the stock is priced based to its pre-COVID levels is very important. Like I gave an illustration that there are certain airlines that are actually higher now than they were pre-COVID. And while we hope, while we speculate, while we anticipate that they're going to make nearly the same amount of money that they made in 2019, it's anything but a foregone conclusion. They're not all priced there, though. Some are trading lower. I don't have the exact ones because I'm not an airline trader. I'm just giving.
That's okay.
I briefly looked at it the other day. Same thing with retailers. Same thing with some retailers. There are some retailers that are trading still very discounted to where they were at, right? You can look at those and say, okay, I have a little bit of cushion where I could buy this because I'm still close to a low level. But if a stock has run, this is a thing that I always think about in stock trading in general. If a stock has run and the fundamentals haven't changed, but it's run, there's a very good, and you saw this in GameStop, and you see this all the time. There's a lot of speculative little fervors that happen here and there. If you get a huge asset move, but the fundamentals haven't shifted yet, you're in a very short window of time before the fundamentals can change, before gravity and like reality doesn't set in, if that makes any sense. Like you need the next earnings report to show this momentum that everybody's been buying.
You need a catalyst to substantiate the action that already took place in order for it to not go. Absolutely. That's what I always say.
I'd rather buy some of those companies after the next earnings report that concludes that they are out of the woods, because then I think you have a better trade.
So the biggest factor for you, or the number one factor, is you want to see strong momentum. You want to obviously see price going above the level that it traded, above last February's level, in a nutshell.
Listen, if you're going to be a value investor, how are you going to buy a stock at its all-time highs?
Oh, no. I'm not a value guy. I just want to make sure, because that's my first criteria. My first criteria.
The guy I'm just making a joke, because the guy that was deep effing value, the kitty guy that was GameStop, he was buying the stock. He was saying he was a deep effing value guy. Well, the stock's no longer deep effing value because it's trading at over $100. Nothing valuable about it. So why are you trading it at that point? I don't know.
Right.
I mean, the trade was awesome.
Right. No.
It's 15 deep value, but at 100, now it's a momentum stock. Now it's a growth stock. I know how to trade momentum and I know how to trade growth because I'm a trend follower. I'm not a value guy. I mean revert in the short term, but in the long term, I like to go with trends. So you have to start seeing the trend working in your favor from a fundamental standpoint, is what I'm trying to say. And some of those things that used to be value and they're no longer value. I know I'm talking very philosophically, and I'm not giving people like actionable ideas.
No, that's okay. Because that's no, my first criteria, and I've been telling anyone and everyone, and we've talked about this ad nauseum, that our first criteria is we want to see the stock trading above that breakdown level, which is, before lower or higher. We want to know if it's trading above or below that February level. Yeah. And I'm on the same page. All right. Okay, so you would want to wait for earnings. You would want to wait for it to, basically you would want to know what the story is, and you want to make sure that there's something behind that stock, that it's not just people coming in to buy it because it's low and, hey, it's low, so we're going to start buying it up. That's not good enough for you. You want to see momentum. You want to see earnings.
Right now. I don't think anything is low right now is the problem.
I don't tell that to Warren Buffett.
He doesn't either, which is why he's buying Chinese electric car companies. Right?
Yes. He can't find value. He can't find value anywhere right now.
So I'm just saying,
he can't. I looked at his portfolio, and it was almost. I looked at his portfolio, and it was kind of like, okay, what is the most? We're going to buy the most beaten down stocks. That's kind of like the position he took. You just can't find value anywhere. This is not a value driven market. We haven't been there in years,
And it doesn't have to be. But if you're playing that game, you're playing the wrong game. That's why I'm saying, like, you have a good cushion in buying a stock a company that's trending with their business, like their business units are growing at 100%, 50%, 45% revenue, top line growth. When you start seeing those things, you have a good momentum on that will transpire in the stock at some point. When you don't see that, and I'm talking investing, I'm not talking trading. When you don't see that in a company and you're buying it at a high level, well, you're taking a bigger amount of risk on that you could be very, very wrong in a couple of years.
Right. Absolutely. Can you give us an example or two of a company like that right now? Just a good example of a company or two that
has awesome momentum. Right, DraftKings. Yes. DraftKings. I love that stock. Yeah. That's one of my favorite stocks in the world. And it's one of my money link stocks right now. DraftKings is a stock whose business is growing triple digits. More states are opening up all the time. They almost have a moat around sports betting in the biggest states in this country. And they're gamified.
Funny that you mentioned it. That was my
getting into gaming.
I recommended it yesterday. Yeah. So and it's sports gaming is taking the country.
I've been trading this money link for like 6 months on and off, but that's a trend. That's a company that I believe in because their top line is growing triple digits and they're making billions of dollars. So it's not like I need my thesis to get right for them to be there. I just have to time into the stock trade nicely. They have a lot of volatility because it's a high beta stock, but I don't need the thesis of the company to start to work. The world is their oyster. They're only just going to keep killing more and more markets.
And I love the fact, how the whole industry, the sports betting industry, is just coming around so fast right now that they couldn't have been in a better place. Right time, right place. They're like bing, right on.
And it's
right
cultural.
So I couldn't.
It's so cultural. It's so cultural. People want to watch a sport on their iPhone or on a tablet, and they want to put a bet on it, and they have that. They have that already wrapped up. I don't know.
And their platform is really, I don't know if you've been on their platform, but it's very cool. They have a very, very cool platform, very user-friendly. I like them. I like DraftKings. Very good company, and the stock is one of the better ones. All right, well, let's talk a little bit about short-term trading. What sectors, where are you seeing danger? Where are you seeing the opportunities? Let's talk meat and potatoes here.
I think that I'm watching this 10-year bond. I think that tech is still a little bit vulnerable with how the 10-year. If we break above 150, look out on the Nasdaq, because the Nasdaq is, it had this big move on Monday, 3%, but then it gave 3/4 of it back yesterday, and then it was up this morning when I woke up at 5 o'clock in the morning, and now we're looking to open down. We're recording this before the market opens, and so I don't like tenuous moves like that. And I've been saying this. I've been the broken record on saying this. When you start to see big up days and big down days become the norm, become the regular thing, that is overall a little bit of a bearish sign for an index. So you have to take that into account. I think we're in this bull. I think we're still in a bull phase, but it's getting long in the tooth. You start to see at the end of a bull move before the blow off top, these types of daily bar ranges. Because I trade short term, I'm very like mathematically, I study to the T what a normal daily range bar is on a stock, on an index, and that's how I play my game based on those moves.
What I'm seeing right now in the Nasdaq 100, and I'm seeing almost down to a word what you're seeing right now. I'm very closely watching the Nasdaq, and yes, I believe the 10-year right now is going to create some sensitivity in the short term to the tech stocks. But what I'm also seeing is I'm seeing the Nasdaq. I'm seeing it repositioning itself. I'm seeing a lot of a year ago, 6 months ago, 3 months ago, it was stay-at-home stocks and chips. Well, the chip stocks are still rallying. A matter of fact, and I'll talk about chips in just a minute. But what I'm seeing is, and this is in the top 20%, I'm seeing Marriott, I'm seeing Expedia, I'm seeing Trip.com, I'm seeing Ulta Beauty Supplies. People want to get beautiful, they want to go out, and those are stocks we haven't seen a long time on there. So I think we're going to see some sensitivity to the broader large cap tech stocks. And by the way, they were not big buys. Apple was not even on my 13F list for this quarter. So I think we're going to see exactly what you said. I think we're going to see the large cap, the FANG stocks specifically, cool off a little bit because of interest rates. But I am seeing the Nasdaq being propelled by other companies, by other industries right now. And that's looking promising. Do you think that's going to sustain itself? The Expedia, the Trip, as the COVID vaccine rollout continues?
Well, this is why you're like have to be overall bullish in general. This is a hallmark of liquidity. Like money is coming in every day into accounts and coming into the economy, and it's looking for new homes. And some things get overbought and then they crash, and then other things get overbought and then they have a correction. And I think that it's going to be a trader's market. I don't think that there's going to be like neat rotation. I think those kind of trades was like last quarter, the beginning of this quarter. But when you're starting to see automakers moving 5% a day up and down, you're starting to see volatility, realized volatility, not just implied, spread across the market. Small caps, like we mentioned, some of these different sectors and stuff, they have higher beta already. But I do think you can find opportunities technically in those stocks that are breaking out. And I have a few strange names on my monthly money flow list that just came out this morning from the Nasdaq. I was expecting to see the usual suspects, and they were all like, I didn't even know that was in the like some of these stocks. I was is that an NDX 100 stock?
That's what
I got confused.
You know what? Jeff, you got to hear this. Exactly what happened to you. I was looking at these stocks and I thought I was looking at the S&P, and then I realized I was looking at the Nasdaq. I swear to you, same, because these stocks are not Nasdaq stocks. Expedia, Trip, Ulta Beauty. I'm like, this must be the S&P. Exact same thing happened to me. Yeah. So two more concerns I have before I let you go. I'm sorry. I love talking to you, and this is the only day of the week we get to kind of talk. And this is very unscripted. It's just two guys talking. Two things. One, do you believe the current inflationary pressure we're seeing from interest rates is going to have a negative effect on the hot residential real estate market? Because, lumber prices are going up, basic materials are going up, number one. And number two, I wanted to hear your comment on the super hot and the shortage we're seeing in the DRAM sector right now, because a lot of the self-driving cars are using them. So those two topics, take whichever one you want, how you want to mix them together. I don't care, but I wanted to hear about your
two of my top favorites. Real estate's going to be fine. People are so hungry for homes. They're so hungry to build. They're so money is still cheap, even if it I
was going to say, and money is still cheap, right?
Listen, I was just doing an analysis this morning of the 10-year yield and the 30-year mortgage, and the 30-year mortgage is up like 15 basis points when we're up 60 basis point in the 10-year yield. So money is still cheap for 30 years, 40 years. Money's very cheap still. So you can borrow money
should remain that way. And
it's going to remain
that way for quite some time.
It's going to remain that way. And so I think I think the housing sector is a sector to pick up if people are stupid and they toss some of those babies out with the bathwater. I think the semiconductor cycle is just getting ramped up. It's kind of like the commodity. It's a commoditized cycle, by the way. People that don't understand
it is a commodity. It is a commodity.
It's a commodity. Chips are a commodity. So,
the reason I bring
go ahead.
The reason I bring it up is because Micron came out. They own 50% of all the DRAM that's going into cars. 50%.
Wow. That's stock.
And 50. Yeah. So I just wanted to get your comment on it. I wanted to see if you're in any of the DRAM chips, what you're thinking of them, if you're bullish on, because I'm not really putting chips and tech in the same boat. I'm keeping them separated.
There's tech and there's tech. There's hardware. There's software. There's you have to be slivered up on everything at this point. But if there's a sector of technology, of old school technology that I like the most, semiconductor.
Okay, good. So you and I are pretty much on the same page as usual.
Yeah, you know what I think happens, which I like, Roger, is we talk ourselves into and out of things by discussing things with each other. We evaluate our theses. The weaker ones kind of float to the side, the stronger ones float to the top. So it's good. It's confirmation.
You just reminded me of something. This will be the last question, I promise. I don't want to take more of your time. What you just said actually reminded me of just that gold market. Are you fizzled out on the gold, or are you still a little shiny on it?
I mean, I've been out of gold for a while. I've been out of gold for a while. Like, it's not going to move now. What's going to move to the upside?
Right?
Everything priced in dollars is going higher except for gold. That's that's all you need to know. That is all you need to know right now. And as real rates go higher, it's bad for gold. It's very negative for gold for real rates to go higher.
Yeah, it's not.
Real rates are still negative. Real rates are negative 70 basis points still.
It blows my mind away to think that. It really is, and it just does. Jeff, I could talk to you for the rest of the day. I think one day you should just come out here. We should put a camera. I won't even tell you. We'll just videotape, and we'll have 8-hour session of you.
Well, things are starting to open up, so I can't wait to come up to Ponte Vedra. I think I should be up there sometime this spring. It'd be nice to spend a few days up there.
That'll be awesome. You have. Please, anytime, welcome. We would love to have you here. We'd love to spend more time with you. Always welcome into our office. Jeff, thank you very much. Folks at home, I hope you enjoyed this session. I try to get as much out of Jeff as possible, and I hope you guys are seeing that, we think very, very similarly. Sometimes we come to the conclusion in a different way, but usually we see things, eye to eye, especially when we're understanding, if we're talking about short-term, long-term, and or so and so forth and so forth. If you want to reach out to Jeff Zinnineri, please do. It's jeff@joyofthetrade.com. That's jeff@joyofthetrade.com. If you want to reach out to me, support@marketgeeks.com. It'll just get there faster that way. We won't go through several screening models. So support@marketgeeks.com, jeff@joyofthetrade.com. Jeff, I want to wish you a very happy, a very profitable and prosperous week ahead. And thank you for being on this show.
Thank you, Roger.
Bye, guys.
See you guys.